Well, hello everyone. It's 5 o'clock in Chicago. At least I know many of you are joining from the East Coast to the West Coast. So we're going to give everyone a few minutes here. Oh, okay. Maybe one more minute. You guys look to be pretty prompt in getting on here on time. I hope everyone's having a wonderful Wednesday. I know at least here in Chicago, in the Chicago area, we finally have sun and clear skies. I'm telling you, the rain has been horrible. I know a lot of us have been experiencing neighborhoods with flooding, and so I hope everyone's doing okay with that. All right. Okay, so without further ado, we're going to go ahead and get started here. I know all of you know me, so Dory Rodriguez, and I'm in my lovely home in Oak Park. In my dining room, actually, tonight, I get a lot of compliments on the two paintings behind me, so I said, why fight it? I'm gonna do that. And the topic for today, I wanted to share a quote, but in the overriding topic I'd like to kind of kick this off with is uncertainty. And I found a quote by Eckhart Tolle: if uncertainty is unacceptable to you, it turns into fear. If it is perfectly acceptable, it turns into increased aliveness, alertness, and creativity. So I thought that would be very fitting with the day. And I don't know if many of you saw a LinkedIn post I just put up yesterday, but a chairman and co-founder of Dimensional Funds, David Booth, had a really great piece that I shared yesterday. And he as well talked about uncertainty. And one of the things that I wanted to share, he said, at any time, anytime there's uncertainty, and perhaps there's never been more uncertainty than right now, we as people, we want forecasts. And he goes on to say that if you know him well, he's not in the business of forecasting. And we as human beings, we're all wired to improve our lives and the lives of others. And we're all pitching in to try and help in any way we can. So we fix problems that need fixing, and we're in the business, and that's the core of every business. So I thought how fitting that was to feel that, being in the business of forecasting, and all of you know, and all of you on this call right now in this webinar, you have a lifestyle financial plan that we have crafted and put together, and we've spent a lot of time making sure that we are forecasting what the future might look like. And as you know, when we're reviewing plans and bringing in the investments that help fuel those plans for your life, I believe in this time of uncertainty, that brings a little bit of kind of calm and peace in a time when we really have a lot of questions. So I thought that would be fitting. In terms of housekeeping, real quick, all of you are obviously muted, but there is a Q&A at the bottom of your Zoom screen. So during this call, please feel free to ask questions. And as our speaker is talking, we will be very live back and forth. So I'll make sure that I'm asking your questions in a timely fashion and answering those questions. And then I will also have a poll sometime during this webinar, which gives you the opportunity to select what future topics you'd be interested in. So without further ado, I'm extremely excited to introduce our featured speaker today. And before I do, real quick, I have a few thank yous. I have a thank you to Joe Wozniak and Joe Emmering from Dimensional Funds. You've always been such an amazing support to me and my business, and making sure that everything that I need for myself and for all of you, my clients that are on this webinar, you've always been there and very supportive and very helpful. And a special thanks to Stu Koch, who I know is also on this call. She's a social media expert and was really helpful in making sure that I came on and appeared the way I do now. So thank you to you, Sue. And to all of you who are my clients for trusting me and working with me in this time of uncertainty. So it is my pleasure to introduce Apollo Lupescu from Dimensional. He's a vice president with Dimensional Fund Advisors. He started there actually in 2004 after finishing up his PhD in economics, University of California in Santa Barbara. He's currently in the Santa Monica area with his family and his two children who are 16 and 13 now. He's working from home. And he frequently speaks with Dimensional, actually around the world. And he's been titled the Secretary of Explaining Stuff. So he travels around the world. He works with individual investors and financial advisors and our clients, such as myself and everyone on this webinar. Before that, Apollo worked with his own consulting firm. They had services for the U.S. State Department and the White House on a variety of projects. He's obviously interested in finance and investments. He had a teaching engagement at the University of California in Santa Barbara. And before that, got a BA at Michigan State University. So Apollo, we do have something in common. I was a swimmer my whole life, transitioned to triathlon. So I understand you coached and competed in water polo at Michigan. So welcome. We're very happy to have you and excited to hear you explain some stuff to us.
Hi, Dory, and thank you so much for the invitation. And thanks to everyone for taking the time this afternoon and listen in. And I do miss swimming. That's the one thing that I do miss quite a bit. So, I think Dory kind of had a really a good point that these are uncertain times, and what I feel for a lot of folks, and particularly successful professionals, what feels different is that whenever there's so much uncertainty, there's a loss of control. And whenever there's a loss of control, that I think that it really impacts all of us. And we like to get a little bit of clarity. We like somebody to kind of tell us where the world is going and what's going to happen. And particularly, as she said, times like this when there is no real clarity, that's what makes it so hard. And what I like to do is try to start with giving you at least a perspective, and not that I'm going to give you clarity. I think nobody can give you exact clarity, but give you some perspectives that maybe will help you just understand the subject a little better. And I think with that understanding, hopefully, might come some peace of mind. So I'll start with a topic that has to do with turbulent times, and that is politics. I'm not going to dive into politics, but I will touch on the subject of elections, because one of the questions that I've heard for pretty much the entire year has been, how is politics and elections impacting my portfolio? Should I be doing something in response to the election, and whether or not it matters if one or the other candidate would get elected? So I think it's a pretty good place to start. And beyond that, I would love it if you can actually submit questions. There's a chat box and there's a Q&A box. If you submit the questions through the Q&A box, the only people who can see those questions are Dory and I, so they're private. And please go ahead and let's try to have an engagement rather than just me doing a monologue. So the more questions, the more I can respond to your questions, I think the better off all will be. But I will start with elections just to kick it off. And we've looked at this issue because it is important to investors, and we like to know, is the election itself, by being an election year, is that a trigger to take an action when it comes to your money and your investing? And we've certainly explored that question. And then there are other questions that are worth looking at, which is, does it matter if we have a Republican or a Democrat when it comes to your money? And then last but not least is, how would politics in general impact investing, particularly looking at companies that might be impacted by one just policy or another. So this again tying to politics with the business. How is that reflected into people's investments? So I'll start with those three questions, and then after that, hopefully you'll have some more questions, whether about the current market conditions, about what I'm talking about. It could be about anything that has to do with investing in the economy. So let me start with just the first piece. And Dory, if you can enable the share screening, I think that would make it easy. So the first question is about election and politics, and it's a very personal subject. And I'm not here to make anybody feel good or bad about their political views, and manage anybody's feelings. I mean, it's really more about managing the assets and the money, and how do you think about it from that perspective? And when you think about the markets and the economy and the investing and the elections, let's start with the first question. Does it really matter if it's an election year? And we looked at the data. It turns out that in the U.S. stock market, we have good numbers, good evidence, good data, starting in 1926. So 1926, that's when we started collecting good data on investments in the stock market in a more robust way. And when we examine the data, what we see is that on average, the US stock market grows at a rate of about 9 to 10% per year on average over the long run. Any given year, it could be anything, but when you take enough length, 10, 15, 20, 30 years, 90 years, it becomes 9 to 10% per year. And within the investment community, it is pretty widely accepted that 9 to 10% per year is a pretty good, reasonable average for the US stock market, the growth over the long run in the stock market. Now, this means that we have good data for about 93 years or so. Now, within these 93 years, there have been 23 different years with elections. So the question is, if you take that sample of 23 years of the election years, how different is that average from the average of all the years in the US stock market? And I wish you had a poll here, and I would ask you how much above or below do you think that average is for the 23 election years? And when we looked at that, what we found is that what we found is that on average over the 23 years when we had presidential election years, it has been pretty much spot on the same. So in that respect, on average, the election years don't behave any differently than any other year in the market, on average for the 23 election years. So to begin with, it doesn't seem that on average, any one election year the election year seems to be better and worse as a whole than any other year. Now, that average means that some years are good years and some years are not such good years. So what I thought would be instructive is to look at the years when the market actually dropped during an election year and see what we can learn from there. The first time we saw this was in 1932. And in 1932, the market dropped by about 8%. And we did have an election year. It just also happened that 1932 was during the Great Depression, and that was a really major event that was going on at the time. And 8 years later, in 1940, once again, we saw a negative year in the market. But there was also the year when Germany invaded Europe, and it became pretty clear that this is going to become a world war. It took 60 years until the next time, and it wasn't until 2000 when we had an election year with the negative return. And we did have that election. It just turns out that there was also the year when all these .coms, the pets.com, and all these high flyers that they had no really viable economic path, they all went down. And so it was an election year, but it was also the year of the .com bust. And last, obviously, but not least, was the great financial crisis and the election of 2008. So to me, as I looked at this, we had 23 different election years. Out of the 23 different election years, only 4 years had negative returns. And in each one of those cases, it seemed there is something a lot bigger going on in the world than the election itself. So to me, it doesn't seem that the election year itself would be an impetus to make a change in the portfolio. It's on average is about the same. And then if the market drops, there are other bigger things happening. And knock on wood, let's say that this year ends up being a negative year. When we look down at this year, I'm not sure that many people say, well, it was the election to point at, or the coronavirus. So there are other much bigger things happening in the world. And to me, even as we see these negative, there are other things that might have caused it. So the first big thesis here is that there is no reason to make a move in your portfolio with respect to the election. Now, what about if a Republican, whether Republican or Democrat, is in office? Does that make a difference? And in this case, I didn't go back all the way to the 20s. I actually used just my lifetime. I'm born in 1969. And when I was born, President Nixon was in office. And for the 5 years that he was in the White House, the market dropped on average of about 3% per year during his tenure. That was the years of the 73, 74 is a pretty major crisis in the economy and the market. And then following that, you had President Ford for 3 years. And on average, the market went up 20% in those 3 years. And as you fast forward through the different presidents and the different tenures, this is the average per year during their tenure. What you see is that there is nothing really obvious to say, boy, having a Republican or a Democrat in office would be better or worse. Not at all. It doesn't seem obvious at all from just looking at the data. But there's one other thing that jumped at me. I remember President George W. Bush being very, very friendly towards the business community and towards investors, because the dividend tax was cut, long-term capital gains tax rates were cut. So you have a president who's really supportive of investors, very business friendly, and yet during the 8 years that he was in office, the market dropped on average of 4% per year during the 8 years that he was there. So the question to me is like, okay, well, how much blame should he receive for this? And then you think about it, he walked in exactly as the dot-com was going bust. He didn't have anything to do with that. 9/11 happened 9 months into the tenure, and he walked off at the very bottom of the financial crisis. Should he receive credit, blame for that? I don't believe so. And whether you're a Republican or Democrat, you can also look and say, well, if you look at like President Clinton, he presided over this tech boom, and talk about market timing. He walked off precisely before it busted, so his the annualized returns during his tenure look good. So to me, the major thesis here is that there are bigger things happening in the economy, and a president should receive neither credit nor blame for what happens in the market, because there are other bigger things at play and things that might have just walked into or walked out of at different times. So that's the second thing, is I don't necessarily look and say it's obvious that one or another is good for business or not. The third piece, which I think is crucial, is that to understand what's going on here is to look at whether or not an administration's policy towards a company or an industry make a difference for investors. And I think that we have a natural example right now, because for the past few years, we have had this push to support domestic steel manufacturers, and it's an industry that really has been supported by current policies. And I'm not here to talk if they're good or bad. I'm just looking to say, well, we have an example. We have a company and we have a sector that has been supported by tariffs. And can we look and see how much did that support the industry relative to the market as a whole? How did that company or the sector do, having the full support of an administration, and how do they do? And for that, I thought it would be interesting to look at the company that actually carries the name of the industry, U.S. Steel, and see what happens. And this is what's been going on with U.S. Steel for the past few years. And what you see is that's quite remarkable, is that from the time that the tariffs were put in place, it's been pretty much a steady way down. Even with the support that they got from tariffs, again, there are bigger things at play that could not make this company thrive for one reason or another, even with the administration's tariffs in place backing it up. And it's the idea that what matters in terms of profits, which is basically what you're buying into this company, is the product you have, what the industry as a whole is doing, what competitors are doing, your strategy, how you execute it. Those things are much more important to an investor than who exactly is in the White House and what the policies are for any one company. So to me, when I look at all these and just kind of try to draw a conclusion, is that the stock market is not really driven by who's in the White House. The stock market is driven by the profits of these companies, and the profits of these companies matter a lot more. They depend a lot more on the company's own initiatives, the company's own products, competitors, and just overall industry trends, rather than the policies in the White House. So that was a little bit of an intro to this. again, whether you are a Democrat or or Republican, whether you consider this, any one administration to be good or bad, competent or incompetent, whatever words you want to use, ultimately, what I can tell you is that the bottom line for an investor is not who's in the White House, but rather the company itself and what the company makes. Take Facebook, Google, Apple, GM, all these companies. It's not necessarily the overall policies. Is what's the product? What's your strategy? How do you execute it? What do competitors do? That is much more important than the policies coming from any White House, any one White House. And it's been like this forever. So maybe this would be a good time to kind of turn it back over to Dory and see what would be most interesting to your folks to hear beyond the election.
I think, and you addressed kind of the concern of, any one particular individual being in the presidency and how that may reflect. But a few questions came in about, the disconnect between the economy and the market, and the rebound seems significant. Can you maybe touch a little bit on that?
Yeah, absolutely. That's a really big topic right now, because what people are seeing is, look, we're close enough. We're going to reach the $100,000 people dead, which is an incredible number. 36 million are unemployed, and somehow the market staged this big rebound. Why is there such a disconnect between the two? And it has to do with the fact that they are related in some ways. I can't say they're not related. They have to do with businesses, and absolutely, in that respect, intuitively there should be a connection. But what I can tell you is that they're related, but they're not the same. And one way that I've been thinking about it is watching my 13-year-old daughter that Dory mentioned walk our little dog. And we have a dog, it's about a year old, and it's just very full of energy. And as they're walking on the street, I can see my daughter was going a pretty steady pace, and sometimes a little bit faster, sometimes slower. And the dog was on the leash, and they both would go in the same direction. They eventually end up in the same place. It's just that my daughter, and in general, the dog walker tends to have a pretty steady pace, a little faster, a little slow, but pretty steady. And that's the economy. The market is connected to the economy, but it's kind of all over the place. It's moving a lot more. It's in front of it, behind it, on the side. It's all over the place. And in that respect, the market and the economy are related, but they're not the same. So why are they not the same? Because the economy has to do with what is going on right now. What's the level of economic output? Prices and inflation, unemployment, all of these are giving us a snapshot of the economy right now. So in a way, it's like the paycheck that you get right now. How is your paycheck that you get right now in a big scheme? The stock market allows you and I and everybody to partake in ownership of companies, and it gives us a stake in capitalism, because I can be part of Coca-Cola and McDonald's and GM and Ford and Tesla and you name it. I can partake in ownership of those companies. That's what you get in the stock market. But when you do that, the reason you do that is because you pay some money now, but in return, what you expect is to get paid for many, many years down the road. So the stock market is not about just what happens right now. The stock market is a forward-looking pricing machine that is trying to figure out, how much are all these payments that I'll receive as a business owner? How much are they worth it in today's dollars? And that's the price that you pay. So the stock market has to do with the future, whereas the economy is about what happens right now. And as a visual, the way that I thought about it, I used to work in a photo lab way years and years ago. And my dad gave me a present in high school, a darkroom. And I am fond of film, and for some of the young folks, it's like, what is that? Well, that's what film used to look like back in the day. And the economy is basically a snapshot. It's a frame. It's a particular scene. But when you think of the stock market, it basically involves ownership that goes for a lot longer. So it's almost like the economy right now is a snapshot, a frame, a scene into a much longer movie that is owning a company. Because when you own a company, you're going to have it for years and years down the road, and you are expected to get paid for many, many years. How many years, might you ask? Well, even if you don't plan on keeping it for that long, the market is trying to understand how long would you get paid, and that's what the market price reflects. And some of these companies have been paying investors for a long time. When I mean a long time, I'm not talking about 5, 10, 15, 20 years. Some of them have been paying investors over 100 years. And these are companies that you're familiar with. If you had been an investor in these companies over 100 years ago, every year you would have gotten paid in these companies. And I was curious to see what's the longest paying company, and it turns out that it is the York Water Company. It's a Pennsylvania company that I've never heard of, and they have been paying investors since 1816. That's 40 years after independence. They have been paying investors. So this is a very long-term proposition. And if you think about it in debt terms, I'm going to get paid. So that the economy is what I get paid right now, my current paycheck. These are paychecks that I'll receive for the next 100 years. How much does it really matter the next 6, 9 months, a year when you're going to get paid for this long? So in the big scheme, the market's trying to look forward and is trying to anticipate some of these economic conditions. And when it does, it might actually react ahead of the economic conditions. Now, it's nothing else. It's just that it's anticipating, and there's a certain expectation. And that's exactly what we saw in 2009. 2009 was the worst year of the economic downturn. The market reached the bottom in March of 2009. And for the rest of the year, the unemployment got worse and worse and worse and topped off at 10% in October. Yet over the period between March and October, the market kept going up and up and up, and people wondering the same thing. How come the market's going up when this economic condition is so bad? These conditions are so bad in the economy. Why is the market going up? It's a simple thing. The market is forward looking, and it kind of had a good expectations that the unemployment will continue to go up. And as long as the unemployment goes up at the rate at which the market expected, market participants expected, then there's no surprise. So when we reached that, we already knew that this is coming. It's just, but the market also saw there's light at the end of the tunnel. And that's what the market's trying to do, is look into the future. And as long as the expectations are in line with what actually happens, the market will be forward looking. And that's what we saw in 2009. Market bottomed out in March. Unemployment peaked in October. So about 6 months before that, the market had a sense of that. And by the end, during the worst year of the economic downturn in the great financial crisis, the market was up about 26%. So certainly it's in line with what we're seeing right now. So that to me is why I would say that be careful with comparing the two. They are related, but they're not the same.
Excellent. Thank you, Apollo. We had another question, which is a nice kind of continuum. So with obviously the current market challenges being unique with the effect of COVID, and with that in mind, with tough times, and we get ingenuity and opportunity created, are there certain sectors or certain companies that you think would likely benefit and would be given opportunity, be a more opportunistic kind of frame because of all this? And
Yeah.
also with that, we hear sometimes that now is different, right? We look back and we think, no, this is such a different time. Can you maybe give some framework on maybe some other times in history that kind of are relevant?
Yeah, absolutely. So those are two very good questions. So let me start with the first one, which is it's something that I really like, because really smart investors are looking at times like this, not just in panic, let's run and flee, but where's the opportunity? This is what Warren Buffett's been saying forever. Buy when there's blood on the streets. Be fearful when others are greedy, and greedy when others are fearful. So it certainly makes a lot of sense to look for these opportunities out there. And I'll tell you that there are two ways to think about this, because what we're trying to do is find these opportunities to make money. And there are two ways to think about it. And if I would say, let's just say that this square is the entire stock market. What searching for these opportunities, whether they're sectors or companies, basically means is that you want to look at the entire universe of opportunities in the US and around the world for that matter. And you want to select what you think are the best choices going forward based on COVID and what's happening right now. And certainly something that is intuitive, because that's what you would think an investment manager would do. And to me, when I think about this, there are two considerations as it comes to trying to do this and select just the right investments. The first consideration is that um, when you think about doing this, it turns out that you might not be alone. You and I might not be alone. And right now, to give you an idea of how competitive this investment industry is, there are more professionally managed mutual funds in the US than stocks trading on the market. It is not competitive, it's hyper competitive. Everybody is looking for exactly the same things, the same opportunities. And what we found is that, and actually taking a look at this, what we found is that in this hyper competitive world, these opportunities that become pretty obvious, what happens is that the price starts to get bid up really, really, really quickly, because everybody is looking for speed. And as the prices get bid up, what you find is that even though it's a really good idea and it might be well positioned, by the time the price goes up, it might not be a good value. It might be nice to say I own it, but by the time you consider how much you paid for it, it might not be a good deal. Think of eBay. If you have something on eBay that's really neat, and you're the only bidder, you might get a really good deal. But when you get hundreds, if not thousands, of very knowledgeable bidders all looking at the same thing, eventually the price starts going up. Where it's like, yeah, it's nice that somebody bought it, but it might not be a great deal. So that's what we're seeing right now, is that there are opportunities, and you can point to Zoom, and you can point to other things, that other companies that might benefit after this. The trouble is that by now, by this time, the price is already moved up, and it usually takes a very, very short amount of time for these prices to move up, because everybody has fast computers, everybody's searching for the same things, and at the end, it might not be a good value. The second consideration is that if you're trying to do it this way, in order to benefit and actually have a significant impact on your wealth, you have to concentrate. You have to put significant amount of money in these investments, so they actually are meaningful changes to your wealth. But when you do this, absolutely, you could hit some winners, and you can make a lot of money. And that's one way to think about investing. Um, it's also possible, and I've seen it like the last few weeks talking to investors who did this in oil a few months ago, and then they lost their shirts, some of them in about a month ago when the price went negative. It can also go the other way. So the more you concentrate, the more you can either make a lot of money or lose a lot of money. And in this case, you're kind of shooting for the home run when you actually don't need it. You just need enough runs to win the game. And our investment methodology is a little bit different. Fundamentally, we want to make money. We just want to make it in a more responsible way that wants to take somebody from point A to point B with a lower amount of risk. So kind of take away a little bit some of the risk. And one of the fundamentals way you can do it is to consider these opportunities, but then to add others around it, such that not any one of these sectors or companies would have a meaningful impact on your wealth. And basically what we're trying to do is put some boundaries around the range of what can happen with your money, shrink that range of what can happen with your money. In this case, a typical portfolio would have thousands of companies around the world, and it's quite unlikely that thousands of companies will disappear at the same time. So we're taking away this. It's also true that because not any one of them has a material impact on your portfolio, we also take away some of the extreme positive outcomes. So to me, that strategy is interesting. It's appealing. The considerations that I'd have is that by the time you look to buy these, they tend to be expensive and not a good deal anymore. And second is, to really benefit, you need to put enough money where then you create perhaps more risk than you ought to do. And to me, the ultimate thing that hopefully we'll get a time to touch on this is the idea of a financial plan. How is that helping you get to your destination? Because even if you say, I want to make a lot of money, well, how much risk are you willing to take to make that money? How much risk can you take sometimes to get to that goal? And quite often you find that you don't need to go nuts like this. You don't need to expose yourself. You might be better off doing it in a way that's more disciplined and diversified. So that's on the first question. On the second question, which is how um, different this time is and what do we learn from history, it turns out this is different because in a typical economic downturn, we have something called a demand side shock, which means that either consumers, companies, or the government cut spending. Then because of that, firms don't produce enough, factories don't produce as much, and there is a contraction. And what you do is there, at that point, the government can step in and give some tax breaks or incentives that would either make the consumers, companies, or the government itself spend more. That lifts production and the economy rebounds. But that's not what we have today. We have that demand side issue, but we also have a supply side, meaning that it's a supply side crisis because the economy just simply can't produce. Even if you give consumers money and if they spend it, the factories can't produce because the workers are still stuck at home for the most part. So having a demand and a supply side shock is not something that's very common. And in fact, going back to the history books, what I found is that there are only three different times when we can draw relevant comparisons to what's going on right now. And one of them is pretty much what you've heard as the Spanish flu. And it's certainly different in some ways. It impacted younger folks, 20 to 40, and it was a different world in a way in terms of manufacturing versus services. So there are certainly differences between what happened 100 years ago with the Spanish flu versus today. What's interesting is to see the similarities and draw some lessons. And similarities start with the way that we're trying to address it now. Put people in a special unit. That's what they did back then. But more so, social distancing. We think this is something that came right now. No, our grandparents did the same thing 100 years ago. That's when they shut down schools and churches and theaters. All assemblies were banned. And it's exactly what we're going through. And in fact, what's eerie is that the first city to do it back then, as well as this time around, was Seattle. And then from there, kind of spread to the rest of the country. And so we did go through the same type of quarantine. And if you look, basically, the masks were required the same way that it seems like these days in some parts of the country. There was a police force to enforce it. The advice that we got was not unlike today: go wash your hands, don't put your fingers in your mouth, and stay away from sick people. So it's not very different. But what's important is to learn the lesson that to me was so well articulated in a paper that was published not too long ago, a few weeks ago, by two economists at the Fed and a PhD from MIT. And what they did is they looked at cities and what they called the non-pharmaceutical intervention, the NPI. And they said, okay, how did these interventions, the cities, the response, their actions, how did they impact not only mortality rates, but the economic outlook afterwards? And what they found, which is so interesting, is that cities that reacted early and they stayed closed longer, at the back end, they had a better economic outlook than the cities that reacted late and started and open up early. In other words, the debate that we're hearing right now between it's health or economics, it doesn't seem to be the case. It seems that you can't really solve the economic crisis until you solve the health issue. And that's what this seems to be the case. It doesn't matter if the city's open. If people don't feel safe to go out, you won't resume normal economic activity. So it's a fascinating little paper that is a letter for us today. and somebody brought up, wait, but this is a different world. We have the internet now, we have Zoom, and we have streaming services to be entertained. Well, true enough. What's also true is that back then it was similar in some other fashion. They didn't have internet, but they could pick up the phone and shop from home. They didn't have, Hulu and Netflix and Hulu and Disney Plus. But if you bought this turntable, whatever this concoction is that the dog is staring into, you too can have the greatest artist come and play in your home. And by the way, you don't need Zoom. If you're in quarantine, you're not isolated if you have a Bell telephone. So very similar. And it is interesting to know that after that pandemic, and it was also after the war, what we ended up with is the Roaring '20s. And, people went back to doing what they did. They had a beverage until prohibition came along. The manufacturing started, really going strong. Cities came back to life in a big way. And as a whole, it's known as one of the most vibrant decades in American history. So we did overcome that, and as a society, we really stepped it up. And who knows? Maybe this time around we'll have the roaring 2020s, and that might be a really good thing. So that's the first time, Dory, that we saw a supply and a demand side crisis. The second time was after the Spanish flu, was during World War II, because 11% of the U.S. workforce actually got pulled away from production lines to support the war effort. And it's also instructive of what we did back then and the relevance for today. And what we did is be able to redeploy capital and human capital. And what I mean by that, at the time when all these men had to go fight, there was a realization that women can step in and do the same jobs. And he had Rosie the Riveter encouraging everybody to participate. And to me, it was a watershed moment, because everybody realized that any job can be done by a man or a woman, and we have been inching in that direction ever since then. And to me, the fact that we started, I think that's a really important moment. So we did solve it, because we have a dynamic society that can reallocate not only human capital but also real capital. And what I mean by that is, in a capitalist free market society, companies will find a way to make money in whatever state of the world we're in. And back then, if they couldn't sell cars, well, GM, Ford, and Chrysler, guess what they made? Tanks. Companies that couldn't sell toys, they might have made bullets. That's what we see today. Distilleries are not brewing spirits, but hand sanitizer. You have Ford and GM repurposing assembly lines to make ventilators and face masks. So that is with us today. And because of that, we have to be a little bit cautious when you see and you hear about all the doom and gloom, because it's bad for us today. I just felt like, how would I have, how would it have been to live as an investor in those days? And if I had a time machine to go back and say, well, 1937 was a bad year in the market, really bad, almost as bad as the great financial crisis. We had a rebound in 38, but 39, 40, and 41, by the time the U.S. entered the war in December, they're all negative years in the market. So if I'm an investor and I'm sitting in a dimly lit living room somewhere, and there's this radio just blasting the bad news that we just entered the war, and you look around and you say, well, this does not look good. This does not look good at all. You have all these people in our society being sent away to war. Millions of people are dying, and cities are being destroyed. It seems like investing might be the last thing you ever want to think about right now. It's just not a good time. So as much as we think this is doom and gloom, imagine how would it have been back then as an investor. And what's incredible is, during the darkest days of our parents' generation, the US stock market basically went up every single year of full war, during 42 to 45. And in fact, it had a remarkable average of over 20% per year. So really significant increase in the market for the 4 years of the war. So it is something that is it's a lesson to all of us. But be careful with the doom and gloom, because these companies are so vibrant, and we are so good at reallocating. And even as the CEOs work in their pajamas, their goal is ultimately the same. How do I make money in the market? How do I go and how do I get this company back on its feet? So that's the second time that we saw this supply and demand side shock. And the third one was in 1973, when there was a crisis in the Middle East. And even though we're not directly involved, to show their displeasure with us, the Organization of Petroleum Exporting Countries put an oil embargo against the U.S. And what it led to is basically an oil shortage, a fuel shortage. And he had cars waiting for hours to gas up. And it was terrible. Like, it was just a terrible time. And once again, we had this big supply shock in the economy. And what's the lesson from 73? To me, the lesson is that it will change the country. What we're going through right now, it will change the country the same way they did in 73. How did it change in 73? Well, right after the crisis was over, Congress passed a law mandating better fuel efficiency. In other words, we couldn't continue driving the gas guzzles of the 70s. We had to change and drive more fuel efficient cars. And that's with us today. And that was a direct result of that crisis. More so, if you think about it, and by the way, this could happen today. It's quite possible that one of the changes might be, hey, you can work from home. If you're a doctor, you can do telemedicine. If you're whatever it is, a computer scientist, you might be able to work from home. So there might be changes that we're going through right now. But the other big one was that the realization that to operate an economy, there has to be, you can't be too dependent on foreign players. And oil was a big one. And what we did is we went from that dependency in 1973 to today, where we are the largest oil producer in the world, more than Saudi Arabia and Russia. And to me, it was a direct result of this idea that we need to have look not only at oil from a money-making capacity, but also national security. And it's quite possible that after this, not sure how easy it is, but it's quite possible that there might be a thinking about producing more in the US. And this might be the trigger of the rebirth of US manufacturing because of national security considerations. So to me, it was a very good question. I took some time to answer because these are relevant periods. There are lessons that we've learned, and I think in some ways they have really close parallels to what's going on right now and what we should expect going forward.
Apollo, thank you. That was wonderful. I noticed from the Spanish Flu newspaper, one of the recommendations was to don't spit on the floor.
Yeah, we got past that one. Yeah, fingers in the mouth too, right? Don't put your fingers in the
All of them were there, but that one, it kind of struck me. You mentioned something about financial planning of women. I know we have about a little more than 10 minutes left, so if there are any other questions, please ask. I have one more, but you mentioned financial planning. So as all of you know that are on the webinar right now, my practice is financial planning first. So, you all have financial plans, and it kind of dovetails kind of interestingly and with women where, and Apollo, I don't know if there's any statistics on this, I'm putting you on the spot if there is, but I think women tend to feel like, I just want to know from a financial planning perspective that we're okay, and that we can live and enjoy the lifestyle that we're accustomed to for the rest of our lives without running out of money. But we also want to know what is our required risk needed in our investment portfolios to reach those goals. And women just want to know that. They want a peace of mind, we're okay. Whereas I find as a generalization, men are a little bit more curious than women are about the actual return, what the returns are in portfolios. So,
right.
More kind of the mathematical, I want to know what my return is, where the women are, I just want to know I'm okay. Yeah. So I thought that would be interesting. And I do hope we see more women in the workforce. And even in the 20 years I've been in our industry, to see more and more women in the roles that we're in, I think is amazing. And then one last thing on, working from home, we have about 4 physicians right now, four families, and each of the families have, so we've got a total of 7 physicians right now on this webinar that in some capacity have done some telemedicine. My husband happens to be upstairs. I don't think he wanted to join the webinar, but he's doing telemedicine as well. So while he's talking about really gross stuff in the next room, I'd much prefer talking about money. We do have one ER physician on here, though. I wonder how she's able to do telemedicine, if at all. But Apollo, another question that kind of came out of all of this is just what you see in terms of investor sentiment out there. When I speak with many of the participants on this webinar right now and other clients and even potential clients, I think I'm going to wait. I really think the market's going to drop. I don't feel good about this right now. Do you hear that over and over? Or, even when, through March and April, my encouragement was where's their potential? And let's think optimistically. And when markets are low, it's an opportunity, in my opinion, to buy low. And quite a few of us did put money into our investments. But then still, some people said, you know, I do have this money, but let's do a little bit over the next 4 weeks, or let's spread it out over 6 months. Like, how would you speak to someone? I know everyone on this call has heard me say it before, so I'd be interested to hear what you would say to that.
Well, it's a very good question. And I think that there is, with all the unsettling things happening around us, I think it's natural for people to, at least be cautious and maybe, depending on somebody's personal attitude, to be more optimistic or pessimistic. What I can tell you is that if you do have, if you think about the stock market right now, it is really not necessarily driven by things that we know. But going forward, any day now, it will be driven by things that we don't know. Yesterday, the market apparently went up, generally speaking, because people suggested there is a vaccine that has really good promise. And then that prompted the market. It was something that was unknown, unexpected, and that made it a bump up. So going forward, the market could go up or down. And right now, the value of the market is a reflection of all the, not only that the pessimists are there who believe the market's going to go down, but also the optimists, because for every seller in the market who thinks the market might go down, there has to be a buyer with the opposite opinion, generally speaking. So the market right now is kind of pricing in both the optimists and the pessimists. But whether or not you should invest at this moment, I think that there's a bigger thing to talk about, which is kind of what you touched on. Should you invest right now? I have no idea. I have no idea. And this is why I'm saying I have no idea. When you're thinking about the market, and you're saying, should I put money in the market? Well, realize that the stock market is basically what I mentioned to you, is a place that you can earn about 9 to 10% on average per year. That's the statistical long-term return in the US market. But it turns out that if you look over the past 93 years, there has never been a single calendar year when the market returned the actual average. It's the volatility around it is quite significant. It's a roller coaster. 3 and 4 years it goes up, 1 and 4 it goes down. But in the roller coaster, in my opinion, same with the market, you are better off staying in seat, even as your stomach is turning, rather than try to jump out in the middle of it. Now, the reason I'm saying I don't know if you should invest is because you have to consider this. This roller coaster has been an incredibly rewarding ride for investors. My dad was born in 1926, and if his parents, my grandparents, had put $1 at the time that he was born, by the time my dad turned 92, he's 93 today, that $1 would be worth about $7,000. So it's a really nice, significant growth, but it does have all this choppiness. Now, the question is, for a lot of people, what you also have to consider the need for stability. Yeah, I like to grow my money. I want to eat well, but I also would like to sleep well. So how do you balance that? Well, there's something else that you can do with your money, which is not only invested in owning companies, but you can lend your money to corporations and the governments. And that is called a bond. It's a contract. You get a specified interest rate for a specified period. At the back end, you get your money back. And that type of a loan is very different because you know how much you're going to get. And in fact, if you deal, let's say, with the US government, who has never missed an interest payment or principal repayment, and you give them the money for 30 days, very short term, you get it back plus interest. Over the past 93 years, there has never been a single calendar year when you would have lost money. Very little fluctuation in value, never lose money. Well, there's an investment that is also available to you in these bonds. And the good news is that you earn a little bit above inflation. Inflation has been about 3% historically. This earned you just a little bit above that. So, and the interest rates, they are lower, and so is inflation. So to me, the question is, should I invest in the market? Well, the first thing you need to do is, what do I want to invest in, the growth of stocks or in the safety of bonds? And just to make clear this trade-off, there's this book called The Matrix book. It's one of my favorite books, and it's just like encyclopedia of numbers. And when you look at a growth of exactly the same dollar over the same time frame in the safety of treasury bills at 3-4%, and you say, well, what would the dollar amount be instead of 7,000? I mean, put a number in your head. If you grow at 3-4% versus 9-10, what would the 7,000 become? Well, that book gives us the answer. The answer is a whopping $21. and it's not missing any zero. It's just 21 bucks. So it's a huge difference between growth and stability. And that's why Dory was talking about that very important piece called the financial plan, because the financial plan sits right here and takes account of your circumstances. When do you need the money? How much money do you need? Do you have a pension? Are you a business owner? What type of risk capacity do you have? All of these matter. And ultimately, what the financial plan is trying to do is figure out what is the right mix of stocks and bonds to get you from point A to point B with the least amount of risk. So if you don't have a financial plan, then how would you know how much to put into stocks versus bonds? Should I invest in the market? Well, it depends, because if you're at a point in your life right now where you need stability, or you have enough assets where you don't need to take any more risk, it's possible that you might be heavily invested in these bonds and you don't need to touch the market. If you're 30 years old and you have 30 years down the road, should you put money in the market? Absolutely. Put it on today, because you have 30 years, and you're very likely to actually see the growth much more so than in bonds. So to me, that's a hard thing to answer. Should you put the money in the market now? It depends on your financial plan. That is the most important thing for an investor. You can have the nicest jet, fly from O'Hare, say, I want to go somewhere. I have a G6, whatever it is, the state of the art today. It's awesome. You say it's very shiny, it's beautiful, I take off. But before you take off, you need to know something else. Where am I going? What's my financial destination in this case? And unless you have that through the financial plan, you're likely not going to be in good shape. In the case of a plane, if you don't know where you're going, you're going to crash somewhere. And I think that's why Dory is suggesting that the financial plan is the most important piece of an investment process.
Excellent. Thank you, Apollo. It's so interesting because every single person on this webinar has seen me use that Matrix book in our meetings.
That's great. I love that book.
And only a small percentage of you have been brave enough to take a copy home with you.
It's full of numbers.
It's a great book. It's all numbers, but we love
Yep.
it. We are nearing 6 o'clock. I'm going to do a quick poll for everyone. And basically this poll is asking you future topics. I'm so excited that all of you have been participating with myself and Apollo. I'm so grateful for your time and to be brave enough to do this my first webinar series. So many more to come. And we have a few more people that are looking at the poll. Basically, Apollo, we're trying to determine what would be our next best topic.
That's great. Hear what people have to say. It's not about
Absolutely.
us. It's what's important to the audience. Absolutely.
Absolutely. Absolutely. Well, any final parting words, Apollo? Any predictions or?
Well, the parting thoughts are basically, to me, is that we're talking about markets and economy, and it's certainly a big part of our life. What I would actually like to say is that to me, the most important element of this crisis is staying healthy and safe, and doing it for ourselves, for our family, and the community. And is by far, that's the most crucial part of this crisis, just go through it safely. And in that respect, I can't thank enough the people on the front lines, the medical staff, the people who are basically sacrificing so all of us can be safe at home. And thank you to everyone. And they're just the heroes. And I like to thank you, Dory, for the partnership and the trust that he placed in Dimensional. We're healthy. We're 100% involved in the market every day, and we'll continue to participate and help you and the clients have a successful investment experience. And again, thank you for the partnership, the trust, and for the time this afternoon.
Excellent. Thank you, Apollo. And as everyone's continuing to vote, we have a few more people. You have a chance to submit your requests of what topics we'll cover. And I do get asked the question often, I'm independent, and when we construct investment portfolios, we can really go to any firm that we want to choose the funds and that we work with. And I favor Dimensional, and I appreciate the foundational principles that the academic research is really interwoven in every decision process that Dimensional has. And to me, that's my certainty, right? In a world of uncertainty, that's my certainty, where this philosophy and foundation is core to me and it's unwavering. So that's where I am now. And thank you for everyone for voting. I know we're right at about 6 o'clock Central. Thanks for tuning in across the country, and look for the next ones, and tell everyone else this is going to be fun to do. And follow your time again, much appreciated. And enjoy the rest of your afternoon and evening, everyone else.
Bye.
All right, bye-bye.